I really been liking silver for a while because I think it has a big catch-up trade to gold. And I think that as the precious metals bull market broadens out beyond central banks, so central banks have been the big buyers of gold. But when the public really gets in, I think they're going to buy a lot of silver. And so that's going to create a lot of demand for an asset that's in scarce supply. And the silver gold ratio is very much in favor of buying silver. Silver is still very cheap historically. It's not cheap relative to dollars, right? Because it's at a record high. You know, it's above the double top from 50. Well, certainly central banks, they've been big buyers of gold as they've been divesting of dollars, which makes a lot of sense that, you know, given the trajectory of our debt, it's clearly unpayable. And either we default or we inflate. Either alternative is not good. And so central banks don't want to hold U.S. dollars.
Peter Schiff outlines why silver remains one of the most compelling opportunities in the precious metals landscape. He explains that while gold has led the institutional and central bank bid, the real expansion phase of the bull market begins when the public finally moves in. Schiff argues that this next wave of demand is far more likely to target silver, an asset with a structurally tight supply and a historically depressed ratio relative to gold. Even as silver advances to new highs in dollar terms, it remains deeply underpriced relative to long-term norms. As central banks continue reducing their exposure to a weakening U.S. dollar, forced by unpayable debt trajectories and the eventual choice between default or inflation, silver stands to benefit from both monetary rotation and crowd-driven momentum. Schiff sees the setup as a classic catch-up leg in a broadening metals cycle. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Gold is still above $4,000 an ounce. In fact, I'm pretty sure it's pretty close. I'll check it to being back above 4,100. It's 44,080. So it's, you know, it's holding above what would have been a record high, you know, like a month or two ago. And silver is above $51. So, I mean, silver is above the double top that was massive resistance going back to 1980. Yeah. I mean, silver is off its peak because silver got above 54 and gold got, you know, above 4,300. But the pullback hasn't taken us back very much. So I think the precious metals markets are in very good shape, fundamentally, technically. I think they're around their new support levels right here. Maybe, you know, better support's a bit lower, but they're close enough. So I think they've held up really well. In contrast to, you know, fool's gold, aka Bitcoin, has not held up well at all. In fact, earlier this morning, Bitcoin got below 91,000. Now, that's still a high price, but it's quite a bit below the 126,000 that it hit a few weeks back. So definitely in a bear market there. And in fact, in terms of gold, Bitcoin is off by 40% from its peak. That is a pretty serious bear market when you're down 40%. You know, you wouldn't know that by listening to all the hype in the mainstream media that Bitcoin is so deep in a bear market, but it is. Because I think the best way to measure the price of gold, the price of Bitcoin, is in terms of gold, because it's being marketed throughout the world as digital gold, as an alternative to gold. So I think gold is the proper benchmark for Bitcoin, not the dollar, especially since a lot of people that own Bitcoin don't even live in the United States. So they don't really follow the dollar as much as they follow their own currency. But I think gold is a international commodity, and everybody kind of knows its price in their currency. So I think you should you should try to measure stocks that way. And if you do that, you know, the performance has been pretty bad in the U.S. We've lost about 70% of the value of the U.S. stock market in the past 25 years. That's not a good track record for equities. I'm bullish on commodities in general and precious metals in particular. But I really been liking silver for a while because I think it has a big catch-up trade to gold. And I think that as the precious metals bull market broadens out beyond central banks, so central banks have been the big buyers of gold. But when the public really gets in, I think they're going to buy a lot of silver. And so that's going to create a lot of demand for an asset that's in scarce supply. And the silver gold ratio is very much in favor of buying silver. Silver is still very cheap historically. It's not cheap relative to dollars, right? Because it's at a record high. You know, it's above the double top from 50. But in terms of gold, how much silver you buy today for every ounce of gold, silver is very cheap. So I think that's going to be a metal to own. It's going to benefit from demand as a safe haven, as a monetary metal, but also real world demand for silver, which is used in a lot of things, especially related to, let's say, electric power and things like that. And so silver prices got to go up. And these silver mining stocks, I think, are very cheap. We've got exposure to those in my gold fund. In fact, even one of my, I think my value fund even owns a little bit of a silver stock, just because we thought there was a lot of value in that sector. So put it in the value fund. Well, certainly central banks, they've been big buyers of gold as they've been divesting of dollars, which makes a lot of sense that, given the trajectory of our debt, it's clearly unpayable. And either we default or we inflate. Either alternative is not good. And so central banks don't want to hold U.S. dollars. So what are they going to own instead? Are they going to stockpile euros or Japanese yen or Chinese RMB? None of those currencies look particularly promising either. They've all got their problems. But gold is, the only clean shirt that's not in the hamper with all the others. Gold is the best monetary asset for central banks to own because not only can it be created out of thin air by any central bank, but you don't have any counterparty risk. If you keep the gold in your own country, you don't have to worry about a default or, inflation. You've got the gold and, you can't be sanctioned, nothing. So that's a far superior situation than holding dollars and investing them in U.S. treasuries to get a low yield, but also leave yourself vulnerable to the whims of the United States to yank your treasuries out from under you whenever we decide that it's something that we want to do. So yeah, this is a problem for the U.S. government, and it's going to become a bigger problem as the bond market really starts to sell off and yields really start to back up, and the Fed is ultimately going to up the size of the quantitative easing. If it hasn't already started it started, and have to print more money to buy more bonds, and then the minute they do that, well, then they make the bonds that they don't buy that much less attractive, and so now more institutions, whether it's central banks or individuals, want to get out of their treasuries. Yeah. And now the Fed has to buy more, but that chases even more people out. So it's there's no way out of that spiral.
Peter Schiff points out that the precious metals market remains firm despite recent volatility across risk assets. Gold holding above $4,000 and silver sustaining levels above the historic double-top range reflect a market that has already reset its support zones. Schiff contrasts this resilience with Bitcoin's sharp deterioration in real terms, down roughly 40% against gold, and highlights that the real bull market is unfolding in commodities, not speculative tech assets. He argues that silver's long-term catch-up phase is only beginning as public participation joins central bank accumulation, with structural supply shortages, accelerating global demand, and worsening confidence in sovereign debt. Schiff sees silver miners and broad precious metal exposure as deeply undervalued relative to the cycle ahead. Let's get into the interview.
Other than myself, nobody really recommended physical gold who is in the brokerage industry. Certainly if you were in the gold business and you were selling gold, you recommended it. But I don't recall a firm like Morgan Stanley ever telling their customers to buy gold. And now they're telling their customers to buy a lot of gold. 20% of the portfolio is a big number. And they're saying to take it out of, treasuries, sell your bonds and buy gold and not an insignificant amount, 20% of your portfolio, basically unload half your bonds. And that's a big problem for the U.S. government because foreign central banks aren't buying. And now if individual investors in the U.S. start dumping half their treasuries, well, now who's left to buy the treasuries from the Treasury? Obviously the Fed. But that's very problematic because they have to create inflation, create money out of thin air and buy those treasuries. So the government can spend the money. I think it's back in positive territory, but when Bitcoin was below 90,000, it was negative on the year.
Yeah.
And that's against better than a 50% rise in gold during the year. So that is a huge underperformance on the part of Bitcoin relative to its principal rival, right? Gold competes with Bitcoin if Bitcoin is a better version of gold. If it's digital gold 2.0, then, it's competing with gold. That's the position that it is being marketed to fulfill. Buy Bitcoin instead of gold. That's the whole selling pitch. And clearly, that didn't work out very well in 2025. Emerging markets, are cheap in a relative sense compared to developed markets, and they have been for many years now. over a decade, I think they've been cheap. In fact, they've been the cheapest they've ever been. So as a value investor, I like that. I like to buy stuff that's as cheap as it's ever been. And I think that if I'm right about what's happening with the de-dollarization process and the fact that foreign central banks are not just randomly dumping dollars and buying gold, they're doing it for a purpose. They want to back their currency with gold more than dollars. They want to make this shift in the composition of their reserves away from dollars and treasuries towards gold for a number of reasons, political, economic, all sorts of reasons, validate that transformation. And so if that is going to be ongoing, it has, I think, big impact on the emerging markets, because if the dollar really gets hit, which I believe it will, I think that the losses will be particularly, high against the emerging market currencies. And so that's going to deliver a lot of new purchasing power to consumers in those economies. And that's going to stimulate all sorts of spending, because their money will go a lot further, because their costs will be a lot lower relative to their own currencies that have appreciated. And I think that will also enhance the investment returns in those assets with currency gains. So I think more capital is going to flow in there. They're going to benefit from a more enriched households that can spend more and invest more. And, as they consume more of what they produce, they won't be loaning as much money to America. And therefore, their savings will be invested more productively domestically than loaned out to the United States, to buy houses or, whatever we're doing with the money. Yeah, and so I think this is going to benefit earnings in those countries, economic growth, their stock markets are going to follow. I think it's like a big burden is going to be lifted, because the lion's share of the burden of maintaining the U.S. dollar's reserve status has been borne by these central banks, because in these emerging markets, because they are producing so much of what we consume. That's a massive subsidy. They're lending so much of what we save. So I think to the extent that they're no longer burdened with that, that's going to be like a huge weight lifted from their shoulders, and they'll be able to move around a lot faster and a lot more efficiently without having to carry us. America is going to be in trouble, because now where are we going to get all our stuff, right? All the stuff that we now import, where are we going to make it? How are we going to buy it? I mean, that's going to be very challenging. The job that other countries have is not challenging at all. It's actually quite enjoyable. Just consuming what you produce, that's pretty easy. Yeah. And the methodology for that is prices come down. So, your currency goes up, and so your prices go down. And so more of what's produced in China stays in China, gets consumed in China. So the Chinese enjoy it, not Americans.
Peter Schiff highlights how dramatically the mainstream landscape has shifted. Major institutions that once dismissed gold are now urging clients to allocate 20% of their portfolio to it, an extraordinary reversal that signals deep structural stress in the bond market. If investors unload treasuries to move into gold, the U.S. government will be forced to rely even more on the Federal Reserve, thereby accelerating inflationary pressures. Schiff contrasts gold's powerful performance with Bitcoin's weakness, noting that in real terms, Bitcoin has severely underperformed its supposed competitor. He ties this shift to global de-dollarization, explaining that emerging markets stand to benefit as their currencies strengthen and their domestic economies stop subsidizing U.S. consumption. He sees this transition reshaping capital flows, production, and long-term global wealth dynamics. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.